All right. Hello, everyone. Welcome to this week's Finquidity podcast.
Where we have good news. Good news for risk on. Friday, we saw the inflation data, and the data was good. Was very good, because we've been expecting high inflation. Well, to be fair, it's only 3%. The data was 3%, and the forecast was 3.1%. And the reason being was from August, we saw inflation shoot up to around 3%. I want to say 3.1%. Was it 3? No, it's 2.7 on August, 2.9 in September, and 3% now. And so the expectation was going to be that, hey, inflation should be continuing to rise because of the tariffs and the impact that's going to have, but it didn't rise as what we expected. In fact, in the core inflation data, we saw inflation go from 3.1% to 3%. Well, this just gave market a lot of euphoria because the rate cuts in September through October and now December are almost guaranteed because the inflation environment isn't as bad, which gives the Feds more leeway to make their cuts with less worry about how it's going to affect inflation. And that's kind of been the news right now, right? I mean, that we just saw Friday being quite an exuberant day for all risk-on assets. We have the S&P, I believe, hitting all-time highs. We have Bitcoin recovering from its lows of 106 to now 113. So it seems like we might have flipped the switch. We might be back to risk-on for this next coming while.
Yeah, so, a little bit more on the inflation and why it's behaving the way it is. So we could discuss this, I think, several months ago in our recordings. But basically, the expectation that not only we, but Powell stated, is the expectation that the inflation driven by tariffs were going to be transitory. And everyone hates that word now in FinTwit. Everyone thinks that's a joke because transitory means basically, let's hide that data as it happened in 2022 to 2023. But this legitimately is considered transitory for a very good reason. And it was because the tariffs that were applied to China, across the world, they were negotiated back down only after a couple months. So you can kind of expect that there was a surge in pricing to meet the tariff demands in April on Liberation Day. And then those tariffs actually came back down afterwards. So you see a gigantic wave in a spike of temporary increases in prices, but then you see that peak go down. And I think if this data is indicative of anything, and it's saying that the peak is starting to move behind us now, and we're now more in front of the curve. Now, on top of that, we also have labor market weakness. So if anyone has been paying attention to recent labor data, and I know we haven't gotten any data on that since the government shutdown has begun, but the Trump administration has been focusing on the deportations and the removal of immigrant labor from the labor market. So this can cause two things. Firstly, this causes inflationary pressures on goods that depend on immigrant labor. So we're talking about like agricultural products, right? Like fruit picking, hotel services, something that is more low skilled and is more laborious, that can't be automated and relies on immigrant labor in order to make ends meet. But there's also deflationary pressures as well. And I think that's what we're kind of seeing here, because you have AI automating everything. So that's actually taking away jobs. So you're removing labor participation. But you're also removing demand from the market because you're literally deporting millions of people, and that is lost consumption. So essentially what's happening here is you see the inflationary tariff wave moving back down from the peak, and you're seeing deflationary processes, including AI rollout and the removal of labor participation contributing to a forced suppression of inflation that you would get from interest rate hikes. And I think that we're starting to see the impacts of a deflationary wave coming this quarter.
So your prediction or like your expectation is that moving forward, in the next 2-3 months, the inflation data is going to be definitely at level at worst and getting lower and lower as time continues.
Yeah. So I think that if you look at the growth contributions, a lot of that is based on productivity gain. So if you think about it, right, if most of your GDP contribution is no longer from amount of people that are getting added to the labor force, you really only have productivity as your main driver of growth. Well, what is productivity, right? So productivity by definition is getting more out of in terms of value out for every hour a worker puts in. So if you have increasing productivity growth, not necessarily saying exponential, but just like continued stable productivity growth, you're gonna have to start laying people off, and you're already seeing that in industries across the high skilled sectors. So you're talking about finance, tech, you're talking about middle management, for example, right? Those jobs that provide high income, they're beginning to get automated away. And as far as I know, consumption now in the U.S. economy is driven mostly by high income spenders. So you have most of the stock market wealth, equities and stuff, being tucked away under high income earners, and they're driving consumer demand. Well, now you're taking that part of the leg away, and that leg is a very prominent driver of inflation.
I mean, so at the same time, well, I don't think we're quite at the stage where the productivity increase is causing people to be laid off, not necessarily at volume. It is happening, and it's happening more in the hiring freeze as opposed to layoffs. I mean, it's been, especially in the Canadian markets. America, I believe, is in a similar position, but better off than Canada. It's been the case that there's been a very quiet but long hiring freeze. And I think in America, it's maybe not as bad, but definitely very similar, where the people that are tending to be hired are no longer your new graduates or, younger crowds with little experience. The people who are getting hired are those experienced veterans in the job market, simply because companies are looking to, leverage the experience and, focus on productivity as opposed to having the luxury to cultivate new talent, and hire them for reasons.
Yeah.
So we're definitely seeing that shift, and I definitely agree with you. Since like 2022, I think it's really been the case that, maybe 2023, it's that the high earners and the wealthy, the extremely wealthy of the nation, are participating a lot more to the domestic product, as opposed to the larger by volume low income, medium income families. And it's very surprising. It's very scary. Very scary. I mean, we saw these numbers in July, August as well, where we had infrastructure spending for AI outpace all consumer demand for the same quarter.
Yeah. So what you're kind of noticing is that a lot of growth is being propped up by AI rollout, right? You have productivity growth that's AI related. You have consumption and investment growth, which is a key components of GDP, also being AI related. But then you also see declining consumer spending from lower and middle income Americans. So I think you're seeing a K-shaped recovery that's not being reflected in the markets, right? Because when you look at the markets, what is the market? The market is about predicting future valuations of what a company can be. So like the most comedic example would be like Palantir, like 600 for example.
Yeah.
Because it's hyper scalable. There's not really a physical limit, right? In terms of how much the growth can be capped, right? You have, like Nvidia, for example, whose clients are basically the other Mag Sevens, right? So it's like circular consumption where one drives the growth of another, and that actually inflates all their market valuations. But we're also seeing a lot of loose conditions within the overall broader market where small caps companies like RR, for example, or OKLO, like companies that literally make $0, like Quantum, IONQ, and all that stuff, they're all going up because there's some sort of expectation being priced in right now that in the future their valuations will be multiples of what they currently are right now. And I think this actually moves to our next topic in regards to the proper regime that we're in. So over the last 2 weeks, right? We've been seeing we've been seeing a outperformance on bonds. So I did mention being priced into that trade in our last podcast. I actually sold out, and I made a post about it on X. And I've recently sized into IONQ, so we've just been waiting on that, being patient there. But I think that based on our environment so far, provided that our inflation data is at the very least stable, I think we might be seeing a potential underperformance on bonds compared to the major indices in this coming quarter.
I mean, it definitely has felt like, the risk-on wave is back. I mean, to even give you a bit more confidence in saying that, what was the big worry in the market was that, hey, there's a downward pressure. Some things, even just a minor event will happen, and, well, your risk-on equities, they'll be slapped down 5, 10%, maybe more, in a scary scenario like Netflix. And it definitely feels like the winds are once again changing. And I think you want to talk more about that, right?
Yeah, so there is some sort of change going on here. You had risk off with a lot of fear, like quite literally fear. You saw Bitcoin get liquidated to like 102 from like 116, 117 in the beginning of the trading day on that day. You see the altcoins absolutely getting annihilated. Don't buy altcoins, by the way; they're complete garbage. So you did see a lot of money being taken off the table because people were taking profits, and there were a lot of uncertainties, especially with the fears of a resumption of the Chinese-U.S. trade war. But recently, I think either yesterday or what, we gotten a report saying that the Trump administration and the Chinese government has created some sort of preliminary agreement, I guess some sort of another framework, I suppose, in managing trade tensions. And as of right now, we have seen Bitcoin reflecting that growing sentiment of euphoria. So when you type in Bitcoin right now, let's see what the price is.
113.
It's currently at 113, right? So that's pretty bullish. It's above our KRM line. It's above what we consider oversold. Would I buy it here? Probably not, because it's pretty close to what I considered overbought, temporarily speaking. But if Bitcoin's any indication of risk, it's telling us that the recent lows have been put in, and if provided that there's no other freak news going on, I'm pretty sure the Nasdaq will continue to grind up to new highs, a bit with difficulty, just because of the situation that we're currently in around. There is a lot of uncertainty. Like, if the government reopens like tomorrow, there's going to be a slurry of news, and some of the news could be complete garbage, and that can take us out right immediately. But until then, we're going to be living blind at the moment, and we'll be living headline by headline. I think that's what's been happening in terms of the market.
That was definitely the last 2 weeks, right? I mean, it's been if I look at the Nasdaq chart once again, we were in a stagnant period all throughout from October 10th, October 11th, rather, after the recovery 13th. We were in a stagnant period of uncertainty where, the highs and the lows, they were very ranging. And once we got the headline news of CPI, well, we were like, we're feeling good again. And so, I mean, that brings us to the next event. The next event that's going to happen is going to be the rate cut decision. So that's happening on the 29th. So that's going to be the decision. I think obviously we're all expecting the rate cut. So what's more important, like, once again, is going to be the Fed chair's position, his press conference, and his thoughts on what's happening in the economy. And I think you're right to say. I think we're definitely going to be in an environment where we're just gonna have to play it by ear, see where things kind of are. I'm personally not sure exactly if we are in, a true risk-on scenario. Maybe it's the case that we are in risk-on, but I definitely feel like we're in this transitionary medium between a risk-off and a risk-on. So I think definitely for all the viewers as well, would just say, gotta play it by ear for now. Just keep an eye on the headlines.
Yeah.
I mean, are there anything we would talk about with the personal banking sector? Anything discussion about that? How's that been?
Not particularly. We haven't had any major risk, but I think I did read a recent article of another subprime auto lender like going bankrupt.
Mm-hmm.
I think the second one over the last couple months. So we're seeing some sort of fallout right now when you're lending money to irresponsible borrowers. Just a rehash of what subprime borrowing is. So what the basic concept is that you have credit lenders who provide credit so that borrowers can buy things with it. They can get a certain return, in terms of interest when they lend credit out to a certain borrower. But what happens is if you want to get more yield, mainly because maybe the market is saturated, so there's not a lot of responsible borrowers left or borrowers of good credit worthiness, you start bottom fishing by going for borrowers that are higher risk, right? Kind of like buying higher risk stocks, you expect higher returns.
Mm-hmm.
And this has been ongoing for, I think, probably over half a decade now. So if I remember correctly, it's been ongoing for quite a while now. And now we're seeing a lot of stress in the credit markets because of the Federal Reserve raising interest rates, and also the Federal Reserve decreasing the money supply by literally going through quantitative tightening. So with the credit market being more under stress, a lot of these borrowers are not able to pay back these loans that they borrow to buy, cars, right? You have your typical maybe $50,000 earner getting a loan for a Ferrari or something like that, right? So these people, from an extreme example, are not able to pay back, and these credit lenders are defaulting because they have a bunch of shitty loans.
Mm-hmm.
So do I think it's going to take down the whole market? I don't think so. Personally speaking, we were able to survive 2008, which is magnitudes worse.
Mm-hmm.
And we were able to survive the pandemic, right? Like the pandemic financial crisis.
Yeah.
So we were able to get away with printing trillions of dollars to bail the entire financial sector out. I doubt that something like this cannot be contained, but that doesn't mean that the market is still not under stress. It's still stressed, but I think that the Fed is now much more cautious on playing this, because 2 years ago, when Silicon Valley Bank, so SVB, and other regional banks failed because of a similar issue, the Fed literally did something called stealth QE, which is QE but not QE. They essentially allowed these banks to get credit from the Federal Reserve, even though their assets were maybe like half as value, but they would get these credits to help bail themselves out at the original market that those collaterals were bought at. So these collaterals in question were U.S. Treasury bonds, at that point in time when interest rate went from like 0% to 5.5%, these bonds absolutely got trashed. So they could not use that collateral anymore to market it to get the capital that they needed to run their basic operations and to pay money to their depositors. So they needed to run the Fed to do that, and the Fed basically created this, stealth QE program to bail them out. If I think anything spreads, this program will definitely be reactivated in some different form, and a lot of these regional banks can definitely be bailed out. Now, I also want to move this topic towards gold.
Mm-hmm.
So gold has been taking a shit, quite frankly. It has not been doing super well, but I think both of us expected this, didn't we?
Yeah, I mean, this is a short term. We thought, in fact, it'd take a 10% dip. I think it's finally at a price where, at least according to our model, it's a 5% now dip, but it's 10% at the lows. It's at a price that at least tolerable, according to the model. But gold has been on as we keep saying, a parabolic trajectory. And just to show you as an exercise, I'm going to switch to the logarithmic graph, and I'm just going to look at the gold growth over the last decade. And just quite frankly, just looking at, on a log graph, a straight line is exponential growth. But even in this straight line, we're seeing how, quite frankly, in the last 2-3 months, it still looks somewhat like a parabola, like an exponential curve on this logarithmic graph.
A log graph.
Yeah. So I mean, I think it's our opinion, and we could be wrong, obviously. I think the growth on gold has been too much in too much of a short span. Do I think gold is going to do well in 5 years? I think so. I think we're currently in a place where gold is becoming a good hedge, especially against, the uncertainty and the chaos brought by the current U.S. administration and the current global affairs. But do I think, is gold a good buy right now, or even in the short-term future, the next 3, 4, maybe 5, 6 months? I'm very hesitant. I would say no. But I'm open to arguments.
Yeah, like I think that, I made comments off the record here, but I can say it now. If you did not take profits in the last recent peaks, you messed up. Like, there was a lot of greed with this gold euphoria, where people think that, as in all bubbles, gold or whatever asset can go up forever. But what people often forget is that if they zoom out a bit, this asset has not performed this well in nearly over 40 years, 50 years, right? To think that such a rally can just keep going on forever with no breaks is genuinely stupid. So I think that this recent big pullback we have in gold is not just, traders taking profit, but it's also the realization that, hey, this stock or this asset is not a macro-based trade anymore. This asset is now taken over and hijacked by speculators who are making leveraged bets on this asset. And if there is a proper drawdown, this asset can get liquidated very quickly and take down a lot of leveraged bets down with it, right? So, you speak to the average, I guess, person who follows the Canadian markets, and they'll say, oh, the Canadian stock market sector has been going up. Well, yeah, of course, because it's a commodity-dominated equity market, right? Mm-hmm. Now, is it going to last forever? No, I don't think so. I think that it can last as long as people have faith in continually making leverage bets. At this point, someone has asked me, oh, if gold goes down, does that take the market with it? And my realistic answer to this question is no, I don't think so. Because as we have noticed, when gold has been eating shit, it hasn't actually affected any of the assets, maybe besides bonds directly. And I think one reason that's been happening is because gold has been disconnected from the overall markets. Why? Because of leverage bets. It's moving like how Bitcoin moves. and Bitcoin is not moving as well as gold is.
Yeah.
And that's an indicator of a red flag, in my opinion.
I mean, I pulled it up on my screen and I'll quickly talk about what I pulled up. Is that I pulled up NVIDIA. Because I think a common counter argument is that, hey, look at NVIDIA's exponential growth. But then, going back to the same log graph, if I look at NVIDIA's growth, it doesn't look parabolic even on NVIDIA. And so I just think that, I think gold is definitely in a place where it, at the moment, lesser in proportion about macro, the overall picture of where gold normally sits in, and currently acting slightly more as a speculative bet. I think this was actually quite an interesting discussion, which we had after last week's podcast. Was like, would it be possible to look at an asset like gold and determine what is the intrinsic value of gold in terms of how it's supposed to behave in a traditional macro sense, and how much it deviates away? Because I feel like gold, maybe before 2025, was like an 80% or 70% macro following value, and 30% a speculative bet or value bet. But in the last few months, especially now, it definitely feels like it's like a 60, 50, 55, maybe 65% the case, where it's still a macro following commodity, but that 30% of it value is coming from just speculation and the valuation, kind of the gold rush 2.0. So we'll see.
Yeah,
we'll see what happens.
Yeah, it is pretty hard to like have a breakdown of that, because it's so subjective, right? Like,
so
to
hard.
what extent to what extent is this extrinsic, right? I don't think I can ever give you a number, and we'd be very hard pressed to find a model that kind of represents that. But I think from just the pattern we're noticing is based on historical patterns. Is it normal for gold to have such a fat green candle? Is it normal for gold to have a big, large red candle, right? You know the answer to that question.
Mm-hmm.
This asset is supposed to be a risk-off asset, right? And as we just talked about, at best, our environment is semi-risk-off, right? We're not like we're not seeing markets in shambles right now, okay? We're not seeing people saying it's so over on FinTweet. When that happens, I'll look at gold bugs and I'll be like, hey, you know what? If it keeps going up, okay, fine, that makes sense. But in a realistic investment environment, when the world is doing okay, unless there's some sort of anticipation that something bad is going to happen, you're not going to see, and let me measure this, you're not going to see gold going up like 3% in one day. That's just ridiculous. And it needs, and I think if that were to happen, you'd have to really seriously hedge or consider why this is happening.
You know what, gold bugs, forget this guy. I'm with you. I'm with you. I mean, I definitely think that the world is definitely in a shaky place, definitely in terms of global affairs, geopolitics, and the state of the economy globally, not just locally. It definitely feels like things have been in an upheaval that's been increasing over like the last decade, especially with all the different events that are happening in the world. So I definitely do see the value in gold. I wouldn't go as far to be as pessimistic about gold as my colleague here, but as a fellow doomer, I do see the value of gold, but I just think right now that it's a bit oversold. I think this is I think one of the few times we differ quite a bit, but not by much.
I don't think gold will like be in shambles. I think that's gonna happen is it's probably gonna underperform the market within, I think, when you look in the next couple of years or so, simply because when you see growth like this, it needs to consolidate. Like people don't like buying things when they're completely moving away from the train station. They want to reevaluate and be like, okay, is there opportunity costs here, right? Like, yes, gold has done well, and the stock market has actually, I think, underperformed in terms of gold. Is that trend likely to continue?
Mm-hmm.
You're basically making a statement and telling me that buying a piece of rock that gives you no yield. Well, it gives you a return because of capital growth, but it doesn't give you any interest. It doesn't give you yield, and you're comparing that to fully functional companies like the Mag 7s that are earning billions a year, and you're telling me that these companies that are rolling out infrastructure, that growth won't get, be reflected in their stock price. I find that a little bit disconnecting, but who knows? Maybe something can change my argument. And as I always say, always trade the price action, right? Like never be stuck on a narrative. If I'm wrong, then I'm wrong, right? But I do think realistically though, you are probably better off at this point pivoting away some of your capital from gold and back into equities or some other risk-off assets like bonds in order to hedge against the outperformance that you've been experiencing in gold. It's just I think it's a more appropriate way to handle your capital. But I do respect discourse, and anyone that is able to disagree with me, please put that in the comments. And yeah, I think that's what I have to say for gold and for overall this week's podcast.
Yeah, I think that's a pretty good summary of, I think we covered all the topics, plus a bit more. So, just look out in the market the weeks ahead. Seems like the winds are going back and forth between a risk-on sentiment, a risk-off vibe, maybe a mix of both. So play it by ear, see what happens, and I wish you guys all the best in your trades in the future. Thank you so much for watching, and see you around. Bye-bye.